Okay, let's get started. Good day, everybody. Hope you're having a nice time in the busy run up to the holidays. It's very busy for everyone. Thank you for taking the time out. We wanted to discuss valuations, probably the most interesting topic of all for both sellers and buyers. We wanted to help sellers think ahead to 2022. What can they do? What can you guys do to improve the valuations of your business as you get into the holidays and think about your plans for 2022. So let's jump in. For those that don't know me, I'm one of the three co-founders of the Fortia Group. I'm CEO. I'm a former investment banker with Morgan Stanley and Credit Suisse. I've done billions of transactions over a 20-year career. I actually started my career or my studies by doing a master's in e-commerce way back in 1999. That tells my age. At the time, it was probably one of the first masters in e-commerce around the world. So I've always had an interest in e-commerce, and it's great to be a big part of that now with the Fortia Group doing M&A for hardworking e-commerce entrepreneurs who deserve really good exits. I'm delighted to welcome three esteemed panelists to today's discussion. So I welcome each of you to introduce yourselves. Over to you, Hanna.
Hello, I'm Hanna, Head of Sourcing at Factory 15. Thank you so much for having me on the panel. I think, as you said, this is probably the most important topic for a seller looking to exit, and also the one that we get most questions about. So very happy to participate.
Welcome, Hanna. Kenny?
Sure, thanks, Emmett. So my name is Kenny Vaes. I'm the Chief Investment Officer at Dwarfs, and of course also busy with the M&A at the Dwarfs team. Happy to contribute to this panel, and yeah, looking forward to helping everybody who's listening, either now or in the future, with getting up the valuations a little bit higher when you sell your FBA business.
Great, thanks, Kenny. Welcome, Olivia.
Hi everyone, I'm Olivia Jones. I'm a director in the acquisitions team at Branded, where I head up all of our UK acquisitions. Prior to joining Branded in May, a bit like Emmett, I have an investment banking background, so I spent the last 10 years doing M&A at Goldman Sachs in the city, also based in London. Likewise to the others, really great to be a part of this panel today. Thanks a lot, Emmett, for having me.
Great, thank you, Olivia. Okay, so let's jump in. We have an action-packed hour to give you all today. I'll do a 1-minute overview of the Fortia Group. We have one slide that tries to summarize all the key factors that drives valuation. I'll introduce that and ask our panelists to give their views. We've done some great surveys in the last few months, so to review valuation trends, we'll look back at the key stats from our survey of the aggregators and also our survey of sellers who sold their businesses. We'll go through the top tips from sellers who have successfully exited. We'll spend a good bit of time getting advice from our three panelists on their top 3 tips each for all of you folks. We'll finish up then with the Fortia Group's primary recommendations for people thinking about exiting next year and how to maximize valuations. And we'll have hopefully some time for Q&A at the end. If there are questions throughout, we will field them if they're relevant to the appropriate topic. From a housekeeping perspective, please submit questions via the Q&A button on Zoom. A recording will be available on our website for those that couldn't attend. And if you'd like a copy of this deck, please ping us direct at exits@thefortiagroup.com. Okay, let's jump in. So the Fortia Group, very briefly, we are exclusively focused on e-commerce exits. So all we do every day is wake up and think about how we can help e-commerce entrepreneurs get the best deal for their business. The best deals don't always mean the highest sticker price. The devil's in the detail. I need to think about, the earnout, the partner that you're giving your baby to, and so forth. So this is all we do every day, and we'll be delighted to work with any of you on the call that are exploring exits. Our vision is to be the Morgan Stanley for the e-commerce space. As mentioned, that's where I spent a lot of time in the city of London, working for an American investment bank, a leader at M&A, and we want to provide that level of service to smaller e-commerce exits. In the survey to sellers, it was great to see that for those that sold, 75% said that in retrospect, they would go back if they're doing it again, hire an advisor. So advisors do add value, both to buyers and to sellers. We're here to make sure that there's fair deals for both sides of the marketplace. What are the reasons sellers hire advisors? The first one is to maximize valuation. The second one surprised me, but it's great to see. Usually for e-commerce entrepreneurs, their exit is their first rodeo. You don't have decades of experience selling businesses. I wouldn't try and sell my own house. Every big Wall Street business hires advisors to sell theirs. Why would you try and do it all yourselves? You don't know the common mistakes and obstacles throughout an M&A process. And so we can bring a lot of experience to the table. And the third one is reach. So we know, I think there's 89 aggregators now that have raised $12.5 billion. There's clearly lots of PE firms interested in the bigger deals. So we can help you get the right reach and go to all the high quality buyers as well. So there are some of the reasons. Please reach out if you'd like to learn more. We offer a free evaluation for e-commerce businesses. If you'd like to discuss that again, please email exits@thefortiagroup.com. Okay, let's move on. That's my sales pitch done. What are the factors that drive valuation? Frankly, there's loads of factors that drive valuation. It's not just one or two things. And there are some maybe more priority things like margins, but this is the way we look at it and how we articulated it in edition 1 of our exit guide, which we published last June. So the term SDE, seller discretionary earnings, that's sort of the first step. That's a term probably typical for smaller businesses, or certainly Amazon businesses. Other sort of similar terms are EBITDA, net profit. The definition of SDE is revenue, less COGS, less operating expenses, plus add backs. There's lots of debate as to what add backs are. We've listed some of the typical add backs here. Once you've established SDE, then that is multiplied by a valuation multiple. That multiple there's not necessarily a science to it. There's a science and an art to it. It can depend on growth, brand strength, and we'll go into a bit of detail with the panelists in a moment on that. And then inventory, typically a landed cost is added onto that, and that gets you the ultimate valuation or consideration for your business. So that's my high-level introduction to the key factors. But now I'll ask each of the panelists to sort of build on some of the key items that they think drive valuation. Hanna, I'll start with you, please.
Yeah, so my first take on the slide would be looking at SDE and all the things that could be add bags. I think maybe an easy rule of thumb here would be, if you need that cost to operate your business going forward, even if it will be part of an aggregator, then that cost has to be inside the SDE, and everything that you wouldn't need, which is a non-recurring cost, or that you can take off, and that's maybe like an easy take on add bags instead of, if you're wondering about like what you could add back. Also, therefore, I would advise have that very clear. Know your costs, know your cost structure. Oftentimes we find businesses that are working with outsourced accountants, and they don't really know which costs go into every line. So if you have that clear, it's easier for you to also know what you can add back, which therefore then gives you a higher SDE and thereby drives your or increases your valuation.
Yeah, very good. Kenny?
Yeah, sure. So what I would love to add is that finding yourself in growing segments with steady growing search volumes is, of course, very much adding value to the company you're buying. That leaves also opportunity for growth. So also I would advise everybody not to leave the growth initiatives that you think are valuable, to leave that on the table. I would very much invite you to help the aggregator or aggregators you're talking with sell your growth initiatives. I really think that can add a lot of valuation to the company. So instead of just giving your numbers and say, just come to me, I think it's very valuable if you engage in discussions with the other aggregators and share your thoughts on like growing the business in the future as well.
Very good, thank you. Olivia?
Yeah, sure. I think echoing what the others said on SDE, it's really helpful for you to go into the process with an idea in your head of what that number is for you. and not just an idea, but, you know, having gone through line by line and thought through the cost, do you think they should be added back or not? Because part of the confusion, I think, when people get offers is that different aggregators or buyers are basing their offer off different SDE. And so if you understand it, then you can unpick it with the buyer and get to the bottom of what they're adding back that you're not adding back, or vice versa, and then have the discussion around it. And so it's a much more sort of helpful, informed and quick process when you get there. And then on the multiple, look, I was scanning through this list, and all of these things do matter. But to different buyers, they'll matter different amounts. So, you know, for some buyers, growth is the absolute most important. I know other buyers are looking for Amazon choice badges and they just want to buy things with Amazon choice badges. At Branded, for example, we care really a lot about account health and compliance, and being completely compliant and regulatory sanitary with the products that you're selling. So through the process of meeting buyers, don't be afraid to ask them the question, like, what matters to you out of this list? Is there something specific that matters to you that you value in a brand? And then you can either push that if it's an area of your strength, or if it's not an area of strength, you can be honest with them and talk to them about how it could be improved and what levers you could pull. And if you have a broker like Emmett, you can talk that through with him as well. And he may well know for the different buyers what matters the most. So there is a little bit of an art in the multiple in terms of, you know, different buyers will give you different multiples because different things matter to them, and understanding that will help you a lot in this process. Yeah,
there's lots of nuances to the art of multiples. Question from the audience: what about adding back reduced COGS or unusually high shipping costs due to temporary need for air shipping? Can that be added back to SDE? Any thoughts there?
I would say, if we're talking about air shipping, that is definitely something that can be adjusted. Obviously, as Olivia said, this will also be very different for every aggregator that you're talking to. At Factory 15, we would definitely adjust for air freight. If you're talking about higher COGS because shipping costs have gone up, then that is another discussion, because in that case, we would assume that shipping costs are going down, which is discussable, but not really proven. And there it gets a little bit more difficult to justify what would be a good add back. But with air freight, I would say that is definitely something that can be adjusted.
Yeah, I would agree with that. I think it's hard to justify that a future buyer should make an adjustment for higher shipping costs when everyone's experiencing the same thing and will continue to experience the same thing. But if there was, you know, a period where you stocked out and you feel you lost a lot of revenue, and it was through, you know, maybe an error or something in your team, or something that your supplier did, you've since switched supplier, something like that, that really is one-off, and you can have a discussion and talk through why it's one-off or why it's been fixed now. You know, I can't speak for everyone, but I personally don't see a need to penalize someone for that, and we would look through that and adjust for it. I think on the COGS question, it was, if the buyer is able to lower the COGS, do you give the seller benefit for that? I think that that's tricky. Of course, you know, part of the play of being an aggregator is to have economies of scale across your brands. But if you then pay that away to your seller, it sort of negates that fact. So that's kind of part of what we can bring to the table, and hopefully what you can participate in your earnout, rather than something that's reflected in the LTM SDE that the initial valuation is based off.
Great, thank you all. So hopefully that's helped set the scene for jumping in a bit deeper now. So the next section, we want to look at some trends that we are seeing in the surveys. So we'll first of all start by questions we asked aggregators. We had 38 aggregators fill in a survey, and then we'll go to questions we asked sellers who sold their businesses. So I guess no surprise here. Did valuations increase in 2021 over 2020? The resounding result was 85% said yes. I don't think there's any debate on that. And same for 2020 versus 2019. What is really interesting is, if we look at this slide, looking forward to 2022, when we asked the aggregators, will valuations increase or decrease? It was less people than I had anticipated said they will increase, 59%. So let's ask the aggregators, what are your thoughts here on valuation as we look to next year? Maybe start with Olivia, and we'll work the other way.
I think that there was a peak point for me in valuation sometime around the summer, and things have settled a bit since then. My sense is that rather than broad brush increasing or decreasing, actually maybe the range will widen a little bit. And, you know, I think some of the aggregators have been burned from overpaying, others have formed a clearer view of what it is they want. When you find the asset that's very strategic for you and right for your platform and a good fit for your criteria, you pay more. If there's an asset that's not the case, you either don't bid at all or you bid much less. And so I think that there'll be a bit of a widening as there's more understanding around this space and people's strategies solidify. But I certainly don't expect multiples to go down in the short term. There's some point in this industry where I think the front end of all of the aggregator strategy is M&A. And next year will be no different for that, probably the year after, but at some point the M&A engines will slow and the focus will become on organic growth. And when aggregators do acquisitions, it will be very selective. So I don't think that valuations are going to continue to increase or stay as high indefinitely.
Kenny?
Yeah, I fully agree with that, Emmett. So I think looking back at this year, there's of course a lot of new aggregators coming to the market. So they're, I would say, not dying, but in very much need to acquire some brands, sometimes with some higher multiples. So I think there it drove up the price over the, let's say, the last 9 to 10 months. But indeed, as Olivia said, I think last couple of months we see it already being toned down a little bit. And also next year, I think more aggregators will be more selective in what type of targets they will bid on. So I think from there on, you will have certain brands which have better fits with certain, let's say, aggregators, and there they can find the best price for their business. But I don't see it like increasing a lot, and I think the peak was already there earlier this year. That's my thought on the short run, at least.
Hanna, over to you.
Yeah, fully agree on what was said. What I would like to add there as well is obviously multiples have been increasing because there are more buyers and more aggregators are joining this space, and this is why the valuations have been pushed up. But this is kind of like a two-road street, because as the space is getting more interesting, also more sellers are joining and more people are looking to exit. So the opportunities that aggregators have to buy different companies are also increased. So now it's not just like one, for example, dog collar company, but you maybe can look at 4 or 5 because they all want to look to exit. So the one that is getting that higher valuation is maybe 1 or 2 out of them, but it wouldn't say, so even if it looks like the average is going up, it's just really like the really good ones that get the better valuations, but we can't put that on every company. And I would also like to comment on the comment that was made about on the right, that pet is getting multiples of revenue, because I think pet is a great category to be in. Definitely a good growth trajectory in that category, but I think aggregators would always want to put their deal structure on what we've seen in the slide. It's an SDE plus multiplied with a multiplier, but it's not a revenue multiplier.
Yeah. Agreed. There was a question, when we speak to valuation multiples, can you differentiate between Amazon and non-Amazon businesses? I believe this applies for Amazon. Yeah, just to be clear to everyone listening, that this whole discussion is focused on Amazon FBA type businesses and their multiples. DTC is a whole different discussion. I think it's fair to say that DTC businesses get higher valuation multiples in typically the range of 10x to 12x EBITDA. And we'll talk about valuation multiples for FBA in a bit more detail in a moment. But today's discussion is focused on Amazon. Okay. I thought this was interesting. Yeah, which categories are seeing increases in valuation? Juvenile and baby, number 1, garden outdoor, pet care. Pet care links back to that comment, Hanna, you pointed out, the valuations are going a little bit crazy. We all bought pets during COVID, and now we need pet supplies to service the pets. So there's increased demand. But anything surprise you here when you look at this data?
Maybe surprises me the two that are on the bottom. And that's probably just because that's Branded's two largest categories. So we love those categories. Look, like it goes back to the point that everyone's looking for something slightly different. So
yeah. Okay, great. Let's keep going. So this one was staggering to me and a shock. How many LOIs did a seller receive? So 36% of sellers only got one LOI. I think there's probably a few factors at play here. One is sellers are running their own processes and not maybe getting a lot of buyers to take a look at it. But I think it's also some aggressive aggregators, not the ones on the call, speaking to a seller on a Monday and asking them to sign an LOI by Friday night, or they'll pull the offer. I think there's some of that going on. I think high quality sellers with high margins should be towards the top of this bar chart. Any of the panelists want to comment on this slide? Yeah, sure. Indeed, as you said, Emmett, I think it's good if you want to sell your business, it's good to get more in contact with more aggregators. So I would say at least 3 in that sense. 6+ might be a little bit too much. Also with regards to the workload. So you'll be, of course, sending documentation and support to, I hope, all of the aggregators, which will do some homework on your figures before they put out an LOI. But it definitely makes sense to have more. I think it's also good that you get an understanding of how they work, what they do, and also how the process looks. So also, I think a deal is not only money, but it's also a fit. And I think it's important that you discuss it with multiple aggregators to see also where the best fit is. Yeah. Very good. Okay, let's keep going. So the next question was, do too many entrepreneurs sign LOIs too quickly? Did the successful sellers agree or disagree? I think 67% said agree. You'll see later on the Fortia Group's key piece of advice is, you should take your time to prepare for your biggest payday. If you spend years building a great business, it's your baby. You shouldn't rush to the first LOI. You should really take your time, rather than just signing the first document that comes across. This was interesting, and I think will change. The sellers that answered the survey had sold businesses over the last 1 to 3 years, typically. So the margins were quite high, 43% in the 25 to 30% bracket. I think if we just surveyed sellers from 2021 and certainly H2, I think that number would come down given the headwinds that all the sellers have faced. But it does show you that you need good margins to get away in terms of get a deal done. Or maybe you need, if you do have 15 to 20% margins, you've got to articulate how the buyer can, what low hanging fruit the buyer can execute to get margins up. I think margins are the most important factor, going back to the valuation multiple slide that we had at the start. What do people think here? What are your thoughts?
Yeah, I think it matters. Like, the rule of thumb that we kind of have in our head is a well-running Amazon business should have about a 20% margin, at least. That said, sometimes my operations team actually likes if the margin's a bit lower, and there's some optimization for them to do there. There's some value add that we can bring to the business with our platform, and if we can see a clear path to bring the margins up, that's okay. I'm not surprised that that there's less than 10% is at 0, because that would cause me some concern if I was looking at that too.
There's a question in from the audience: are net margins after Amazon ad spend?
I'd say yes.
Yeah, definitely. But I think margins will become increasingly, let's say, important, because also with the headwind that we see in the e-commerce, it's important to still have products that sell with proper margins. So I think in the coming months also to bring up your valuation, and you can still show very good margins, very steady margins, that will definitely help, in my opinion at least.
Very good. Okay. So what multiple did the sellers who sold their businesses get for their exits, including deferred income, whether that's stability payments or earnouts or any other mechanism? So you'll see that 43% got 4 to 5x STE, 17% got 5 or more. There was an article in Marketplace Pulse, I think it was last week, stating that the typical range was 4x to 8x. In our view, that's a little bit aggressive. It's not what we're seeing in the data. What do you guys think? Maybe start with Hanna.
Yeah, I definitely think that the numbers that we're looking at right now, with most of them being between 4 and 5, is way more realistic on the market. This obviously also has to do with size. So what we're seeing is that as aggregators are getting bigger, also like the acquisitions that they want to do are getting bigger, and obviously bigger companies or like companies with higher revenue tend to get higher multiples, which is why there could be that shift a little bit upwards. But yeah, I feel like a 4 to 5 is definitely way more representative than a 7.
Kenny, or sorry, Kenny, go
I
ahead.
was just going to say I agree with that. Nothing really to add to that.
Yeah.
And this does include also the earnout, Emmett, just to be sure.
Yeah, anything deferred, whether it's stability payment or earnout. Yeah.
Okay. Yeah, I would say we're in the same ballpark there. Of course, it depends. So we tend to focus more on high growth companies. That's just what we like. So we tend to go for these ones. So it really depends also on the growth potential that we see there. So sometimes it can be a little bit higher, and sometimes it's also a little bit lower. But I would definitely say these numbers, so between 3 and 5x, makes much more sense than the 4 to 8, which I've also read.
Yeah, I mean, like it's easy to get offered 8x, but if 40% of that is deferred income that you might never get, how valuable is that, right?
I think that depends as well. Like I can recall one of the podcasts that I've listened from Thrasio, and I think back in the day their average multiple was around 2.7 or 2.9, and after earnouts I think they were close to between 6 and 7. So depending on how good you are growing the companies and the profit split there's definitely room to do so and to give higher multiples away, but that stands and falls with the growth of the company. So
yeah, and look, that's an important point you make. It's important for the seller to do due diligence on the buyer to make sure they have the right team in place, from supply chain to brand managers, to really make the brand get to the next level. Question from the audience: these figures are after or before add backs? These are after. So any SDE figure has to be after any add backs. So that it can include all the items we had on an earlier slide. Any other comments on valuations before we move on? No. Okay, great. So very briefly then, it's important to think about upfront versus deferred. 33% of sellers said that they received 70 to 80% upfront. So you can clearly see that there is typically a deferred component. Although I think it was 4 respondents said that they got 100% upfront. We haven't personally seen any deals where it's 100% upfront. I guess if it's a very competitive situation, it might lend itself to that. Interestingly, was the earnout based on revenue or SDE? This surprised me. We certainly try to encourage the earnouts to be based on revenue. I think it's simpler and easier to measure. I think most of the buyers want to focus on SDE, but there's definitely lots of combinations going on. There's a combination of revenue and SDE for earnouts as well. Okay. This is really critical, right? Was the deferred component realistic? 84% said yes. That's higher than I would have thought. And frankly, it's great to see so that the buyers aren't putting out unrealistic, crazy proposals at LOI stage. This surprised me. Was there a difference between the LOI and the final valuation? One would hope that the red piece of the pie was much higher, that there wasn't much of a difference between the sticker price or the LOI price and the final valuation. If there's good reasons, excuse me, for a reduction, then, well, let's just be clear, it never usually goes up. In fact, it never goes up, it's usually down. If there's good reasons for a reduction based on performance, that's totally fair. But what I really don't like is buyers putting in a high sticker price LOI and then chipping away during due diligence. That's low quality, and I think the aggregators did do that. This is a small industry, and they'll get a bad name for themselves. Hanna, Kenny, Olivia, what are your thoughts on this slide, please?
Yeah, you're absolutely right, and there shouldn't be a big difference. And I agree with you. If aggregators are doing that on purpose and then later trying to really get the SDE down in due diligence phase, well, that makes the word, and they'll get punished for themselves. So it just makes no sense. But what I wanted to comment on this as well is that here it helps, again, if you maybe get like an advisor or a broker on your hand who helps you to get your ad backs clear, to have your SDE clear, because sometimes it really could be that well, a seller is telling you these are my ad backs, and then you go into due diligence and they're just not there, and then that is kind of like nobody's fault, because the seller is not telling you that in well, with bad intentions, but you can also not accept the ad back that is not real. And I feel like this could maybe cause this high percentage of people who didn't find the valuation at the same point.
Yeah.
Yeah, I think that's right. I think if you're clear going in on what your SDE number is, and importantly, you're clear on what the buyer's SDE number is and what that's based on, and if there are any differences, you understand them at the outset before you ever sign the LOI,
Yeah.
then you're going to know a mile off if the buyer is trying to do something sneaky and come up with nonsensical reasons to lower the SDE, because you know that you clarified it at the start and you know that you understand it. I agree with what Emmett, you said, and Hanna said, that that's a very short-termist strategy from aggregators if they are doing that. It's a very small market. Everyone talks to each other. I think it will become obvious who those people are. But sometimes there are genuine reasons to need to lower the price because of things you find out in diligence, and buyers shouldn't feel at the same time that they shouldn't be doing sneaky or dishonest things, and I hope that people get found out for that very quickly. A buyer also shouldn't feel afraid to renegotiate a price because of something major they discover in diligence that they didn't realize before, either that they could have known, couldn't have possibly known from the outside in, because the seller didn't tell them, or something that they were kind of keeping from them.
Yeah.
And of course there are those cases too. But absent of finding out something major in diligence, or very small tweaks to the SDE because of things you discover, and by the way, that can go both ways. It can also go in your favor, and I've done deals where it has and the price has gone up. There shouldn't be really any difference between a well-researched LOI and a final offer.
Yeah. Kenny?
Yeah, I think what could be really valuable for this group is two things. So the first one is get your SDE right, exactly as what Olivia and Hanna said. So it's not always that an aggregator wants to lower the price. I know by heart that we have never lowered the price for any of the targets we acquired in the past year, like ever. So that's good, but we had to like figure it out sometime, because we do a lot of homework at the upfront, so we do take a little bit more time, but that's just because we don't want to haggle about the price later on. So when we put out an LOI, we're pretty certain about it. But we had one occasion last year as well, where the SDE that we went on was higher a little bit because of a normalization. So let's say an add back. And in the end, that add back was not correctly calculated. So there was just a calculation error from the seller. So what we had to do there, and I think that's valuable for this group, is that party was growing really hard. So what we said is, all right, this is not the SDE that we see currently, but let's wait for 3 or 4 weeks. You're growing at a tremendous pace, and then we can still finalize on that bit. So we always try to be fair, and we're like, that's our slogan, entrepreneurs for entrepreneurs. But please have your SDE carefully looked at and make sure to have a broker who helps you with it.
Yeah, very good. Thank you all. Question from James. Are you seeing higher valuations for EU FBA stores or US FBAs? I think I've certainly heard a few times. We hosted roundtables with aggregators in London and Berlin in November, and I've heard a few times people saying certainly in Europe, maybe Q2 and Q3, the valuations got a bit toppy, a bit higher than the US, but that's come back a bit now. Is that, would you agree with that, or what are the trends that you see?
I kind of feel valuations everywhere got a bit toppy. I have to say we do deals completely. We're a completely global team. But the head office is in Paris in Europe, so we do a lot in Europe. And I don't notice a conversation internally that valuations are higher or lower in one place, or if they do go that way from time to time, it ebbs and flows. I wouldn't say I've personally noticed that.
Okay. Kenny, Hannah, any additional thoughts there?
Yeah, I fully agree with Olivia. We wouldn't value a company higher or lower based on the geography where it comes from.
Yeah,
Okay.
I agree, Emmett.
Sorry, you agree. Okay, great. Okay, so we asked the sellers that we surveyed in November if they had one tip to give to all of you folks on the call on how, retrospectively, what would they do to increase valuation? These were the tips over 2 slides. Maybe I'd love to ask the panelists to pick one of these comments and sort of build on it to give some more color. Start with Olivia, please.
I'm just reading them to pick one. You know, I think 2 people have said here, hire experts to help educate me before exiting. You see a range. I think it's very helpful. And Emmett, I hope you don't mind me saying this, but there's really no harm in speaking to the brokers and they'll pitch to you, right? Emmett, you'll pitch about why your service is helpful, yep. What value you add, you know, exits that you've achieved, why you think you've got sellers higher multiples, and listen to that. Speak to a few brokers and see if there's anyone that you feel resonates with you, that you particularly gel with, because you're going to spend a lot of time with them and you need to really trust them. There's absolutely no harm in exploring that avenue. I've seen a range of sellers, you know, from sellers who have sold a business before and don't feel that they really need a broker, don't want to go through a big, painful process, long process, speaking to lots of different people, jumping on 80 calls with all the different aggregators. They just want to speak to a few friends, find a couple of aggregators that those people enjoyed working with and trusted, and run the process themselves very one-on-one, and they understand how a sale process works. And for them, that's the best way. And then, you know, I've seen other cases where a seller really could have done with the help of having an expert prep their business first, and it would have been a much cleaner process. And even cases where a seller's had to bring in a broker halfway through because they've just got totally overwhelmed by the offers they received and they couldn't compare, you know, apples from pears and put them all on the same basis. And it kind of breaks the momentum of your process to have to stall like that, giving different information to all the different buyers. You're never really sure if the bids are comparable. It can be very complex. So there's absolutely no harm in speaking to the brokers, having a conversation. And I think you'll know, like, you know, every one of the sellers we speak to, they're all very smart business people. You'll know instinctively if it's right for you and if it's going to be value add for you. I think it's definitely worth exploring.
Yeah, thank you, Olivia. Kenny, do you want to pick one from this slide or the next slide, what that resonates with you?
Well, to be on the other side of the coin that Olivia just brought up, also be careful with who you bring in, because sometimes we get lawyers or accountants who are not really familiar with the type of business and the way aggregators work. And then it's only, I would say, a burden and not something that helps really a lot. So I would choose carefully. That's my advice on this one.
Yeah. Hanna?
I would maybe go with the avoid stock FBA issues. Definitely yes, because that's the typical thing that we were talking about earlier with ad bag. Obviously, stock outs cause major damage to your listings, and it is hard to argue how that translates into revenue. So it's hard to add that back, and you're missing out on that. So definitely that is a big one that can increase your valuation a lot. Also agree with what was said before. And I would like to add on that as well. Maybe look at the portfolio of the buyer that you're talking to, and then see if you and your company can identify with the companies that they've bought so far. So for example, Olivia was saying that Branded is excited about personal care. Well, at Factory 15, for example, we're very excited about fitness, sports and outdoors. So it's just like, look at the portfolio and look if your company will have synergies with the ones that you're seeing in the portfolio.
Yeah, very good. A question came in from Daniel, relates to an earlier question. What about, how do you think about a valuation of an FBA business that is only running in the EU? I mean, it doesn't necessarily penalize. In fact, it might offer upside, right? If they can bring it to the US and other markets. Any thoughts, folks, on that one?
I would say it absolutely shouldn't penalize the valuation. There's a growth and a geo expansion angle from taking an EU business into the US, and in some markets, for example, like personal care, the regulatory bar to sell products in the EU is actually much higher than the US. So if you've got that sorted out and under control, it's much easier for us to take it to the US than the other way around.
Yeah.
But there's also an angle to take a US based company to Europe. So I wouldn't say that the way that I would evaluate those two businesses and think about them would be different.
Great. Okay, so we'll move on to section 5, advice from aggregators. We asked each of the panelists to summarize their 3 top tips for future sellers. So we'll ask each of you to walk through and build on your top tips, please. Hanna, over to you.
Okay, so the first one, multi-channel presence. What I mean with that is, as I was saying before, we're having more and more sellers ready to exit, and aggregators can really choose in between categories which companies they think will be the future leaders of this category. So if you want to stand out and you want to be unique and add a really good portion of value to your valuation, do multi-channel. So try to go and build an own web page, maybe with Shopify for yourself, and look if you can shift customers from your Amazon to your web page, or even like create new customers at your web page. Because if you're able to, first, that de-risks you from the specific risk to Amazon. It's de-risking for you, but also it proves that you have a strong brand that works outside the space of Amazon, and that is really valuable. And then that kind of like goes hand in hand with the second point I put on, the strong brand equity. What I mean with that is product differentiation. So have clear, why is your product better than the ones that we're also seeing on Amazon? Where's your differentiation? Do you maybe own the molds? Have you made some tweaks to it? Just everything that proves to us that it's not a pure white label, because that gives you a competitive advantage, and it secures the market positioning that you currently have, which also increases your valuation. Same goes with multiple market channels. Try to invest in driving organic traffic and not only cost per click, because we've seen that the cost per click of Amazon ads has gone up in the past, and we expect to go it even higher up. So by going and investing, for example, in an Instagram channel, which can then drive organic traffic, you're again de-risking, and you're showing that you have a strong brand that people want to identify with, and they're not just founded on Amazon, but it's actually the brand equity that stands behind it, and that is a huge factor of increasing valuation. Yeah. And then the third one is just like a little bit an obvious one, but still very important: increase your profitability. Everything. So normally we see with sellers that they would focus on revenue growth, and that can come at a cost, and that lowers your STE. But at the moment where you want to exit your business, your STE, as we already said, should be as high as possible. So there, take your time and look, where are the cost levels that I could reduce? And an example for that would be outsourcing, maybe photographers or creative work, instead of hiring internally.
Yeah. Can I ask on your first point there, Hanna, when you say, do more outside of Amazon, when Factory 14 looks at acquisitions, what percentage of the business do you want to see on Amazon versus off Amazon? Or how far or will you do DTC only, for example, or in the spectrum of fully DTC, fully Amazon, where will you go?
Yes, so our Factory 15, for us, the important part is that it's online sales. So we've bought companies that were 100% on Amazon, and they have worked great, but we also have bought companies that are 100% on Shopify and 100% selling through their web pages, and they also work great. And then we have the potential of launching them either wise, on a web page or on Amazon, and that is a huge growth lever. So for me, if a company has both, and we can just start growing them and start going into other geographies rather than first the other sales channels, that just increases the valuation immense.
Excellent, thank you, Hanna. Kenny, over to you.
Sure. I think so. The first point has again to do with the healthy margins. I think if you can show, especially in the next couple of months, that even with the headwind in e-commerce and the supply chain issues, etc., you can still show healthy margins that will increase your valuation. It's some of the points I think all aggregators look at closely. Second point is your branding. So it has to do with the strong brand equity. I think, as Hanna just pointed out, make sure that you own all the EAN codes and all the specific IPs are protected for yourself, at least in the regions that you're already selling, which is a big plus and something we do our homework upon. And the last thing is growth. So as indicated before, we like high growth companies with a lot of growth opportunity. And it's of course good to show that. And if you're in that, so sometimes we see sellers who say, I'm in this growth opportunity, let me do it. We have the firepower to do it ×2, so why not let us do it and have a good turnout there. So it's good to keep on growing and show that in your figures and sell timely, and also don't get all the growth opportunities already in, leave some for the aggregators so they can help you get the brand to the next level.
Excellent. I think entrepreneurs can do a better job at articulating growth opportunities. I'm a finance guy, but one of my co-founders, Paul, is an e-commerce expert, and his main task for IMs and for exits is to articulate the growth opportunity, to make it easy for you guys in the teasers and IMs to sort of understand what the growth upside is. So when you're presenting to IC, you have ideas, and I think that's definitely a big factor that can help get a higher valuation.
Yeah, sure.
Olivia, over to you, please.
Sure. Okay, so my first one is come prepared. I don't think we need to rehash this one over and over again, but know your SDE, talk to some friends who've sold businesses, understand what the process is going to look like. If that means hiring a broker for you or interviewing a few brokers, 100% do that. Make sure your house is in order, have a sense for even who the lawyer would be that you would hire. Don't have to hire them and start paying them, but think through these things before you suddenly jump into a process that can move very quickly once you get it started. So prep in advance. Don't present an over-optimized business. So this might seem a bit counterintuitive, but I think the temptation is to present an absolutely perfect, amazing, incredible, neatly wrapped in a bow business to buyers. But you have to remember, and Kenny touched on this, that the buyers are looking at it from a perspective of what have you built and where can we take it from here? And so actually being honest with buyers about things that you feel maybe you're not doing so well. There are going to be things that you as an entrepreneur excel at. Maybe you have a background in product design and you put a lot of love and care and energy into the unique design of your products. absolutely sell that and push that point. But maybe you feel, or the reality is you're not so great at marketing, you don't fully understand the PPC, you really think you could be doing that better. It's actually okay to be honest about that, because good aggregators should have a whole host of people internally, operators, who are able to jump on that and do it very well. And so that's quite a nice thing for buyers to hear, that there's still some room for them to add value and improve the business. So definitely push your strengths, but actually there's value to be obtained in being honest about your weaknesses, which is a bit counterintuitive. And then the last point is diligence your prospective buyers. We've kind of touched on this, but you absolutely must do this. I'm really surprised when I speak to sellers. I'll do a sort of pitch about Branded and how great we are. And we are great, by the way. But people just accept that at face value. Like, don't push into it. Ask. I mean, I'm the acquisitions person. I'm an investment banker. I'm not going to be the person ultimately running your brand. I'll be the person that holds your hand through the deal. But ask to meet that person who is going to run your brand. Yeah. Ask about our operations team. Where are our team based? If there's an earnout, how are we justifying it? No one's going to show you their business plan because that's proprietary that they've built, but they should be able to talk you through all the different levers of growth that get you to your earnout. Ask around friends who've sold businesses or been through processes, who've dealt with who aggregators before. It should really be a two-way diligence process, and you need to do that process before you sign an LOI, because once you sign part of the clause in an LOI, and really the only binding clause is an exclusivity clause. That means once you sign it, you can't be speaking to any other prospective buyers. So you need to do this work before you sign an LOI, and push people, interview them, delve in, find out if what they're saying is true. Don't be afraid to do that. It will be valuable for you, and it will build a much better rapport actually that then goes into the diligence process, where you'll be meeting loads of people within the organization. It's quite nice if you've actually met some of them before, or you have a sense for who they are. I think it makes for a much nicer sale process, and it'll make you feel so much more comfortable when you come to sign that LOI in the first place.
Yeah, great point. It's a two-way interview process. It's not a one-way interview process. Excellent. Lots of great points there. There is a question. We'll come to that at the end. So the key piece of advice from the Fortia Group matches Olivia's first piece of advice, which is all about preparation. So I'd just like to take you through a few slides that can help sellers get prepared. I mean, it sounds obvious, but by failing to prepare, you're preparing to fail. Please don't sign an LOI within 4 days of receiving or having a first conversation with an aggregator. Take your time. It is probably the biggest payday of your life to date, unless you've had multiple exits. So you should be spending lots of time strategically planning for that exit. Don't rush. There's four free ways that any seller in the world can leverage from the Fortia Group to help you on your journey. The first is our exit guide, which I'll take you through in a moment. The second is really understand what all these buyers want, and there's various ways we can help. The third is become exit ready. Don't start the process tomorrow. Take your time and get ready. And then understand the auction process itself so that you're on the front foot. Don't be on the back foot. If you're explaining yourself, you're already starting to lose points or lose on the negotiation. So to build on those a little bit more, back in June, we published the first edition of our exit guide. We had nearly 20 aggregators contribute to it, sellers who'd successfully sold their businesses. It's downloadable via our website. We're in the midst of working on edition 2, which we'll publish in early January. And that'll be bigger, bolder, greater, lots more of the intel that we've discussed on our webinars integrated, and lots of great content from the aggregators, including those on the call. So please download that and have a read, and we'll ping you edition 2 when it comes out. Second is you've got to understand buyers. It's a two-way interview process, as Olivia said. You need to understand their checklist, their criteria, and different buyers have different criteria. Some might like sports, some might like personal care. So you need to understand their preferred categories. There's other sort of standard criteria. One that's changed a lot, and we made this graphic back in June. Revenue over $1 million for a lot of aggregators, that's now 3 or 4, because they're under pressure to deploy the $12.5 billion that's been raised by the aggregators, and they're looking to do bigger deals. There are aggregators that do the smaller deals, but certainly the bigger aggregators are looking at bigger deals, 20% net margins, and so forth. To go into all those criteria in more detail, you can click on the recording of our webinar we did our aggregators back in October. So there's we surveyed aggregators, and we did a webinar with panelists from Thrasio, Berlin Brands Group, and Unibrands, and Upper 90, one of the biggest investors in the space. So it's worth taking time out when you get some downtime post Q4 sales season. The third is become exit ready. So in our view, there's lots of operational adjustments one can make, and lots of sort of corporate finance adjustments one can make way before you embark on an actual exit process. So on the operational side, it can be about understanding your unit economics, because in the end, you're going to be the buyers will look at your financials on a SKU level. So it's important to understand unit economics. On the financial side, when we work with clients, we talk to their tax advisors, accountants, lawyers, to make sure that everything is being prepared correctly and appropriately. And we also help the seller think about refining their KPIs, and even getting early feedback from interested buyers, so that that feedback can be incorporated. So there's lots that can be done on a 1 to 2 year view. It's not always just 1 to 3 months. And then finally, it's really important to understand a proper investment banking type exit process. There's 7 steps in the Fortia's process. If you don't understand this, it's a really intense period of 6 weeks to maybe 12 weeks, depending on what type of deal structure it is. It's really good before you go into it to understand all the steps. It's like you've got your day job running your e-commerce business. This is like having another day job. It's really intense. So understanding it and being as prepared as possible, working with good advisors is the best way to get through it successfully and get to that bottle of champagne on closing. Finally, of course, we would say this, but a fifth way to be really prepared is to hire a strong advisor. There's a study done by a university in the States analyzing over 3,000 deals over 17 years that shows that good advisors can get you higher valuations up to 25%. Okay, so let's go to Q&A. I think we have 1 minute left. Let's squeeze in this question. So, detailed question, are any of the aggregators interested in acquiring vendor central accounts with good T's and C's with Amazon that they could use to sell their acquired private label products to Amazon on a wholesale basis, which Amazon could then resell their products to the end consumer on a retail basis, sold and delivered by Amazon? I've never heard of that question. Anyone want to give a stab at that?
Well, I can only speak from Branded, but we, like Hanna, we buy not just FBA businesses, so we also buy 100% direct to consumer businesses and everything in between. And as a result, we do come across businesses that are set up on Amazon using Vendor Central, because it probably isn't their main channel. And at least for us, that's fine.
Interesting. Hanna, Kenny, anything to add there?
Yeah, we tend to focus on let's say the highway, as we like to call it. So not these types of businesses, but mainly like brands that are selling like directly on Amazon themselves. So
yeah. Question: do aggregators prefer to acquire the company or just the brand on Amazon account? And this sort of differentiates, or there's different views. Clearly in the States, a lot of the deals are done via asset purchase agreement, where it's just a brand. In Europe, it can be more difficult with tax for the entrepreneurs. What are your thoughts?
I think that whether it's share purchase or asset purchase, we always want to acquire the actual account. We've looked to buy just certain brands out of an account, and we have a lot of people ex-Amazon working for us as well, and it's just operationally very tricky on the other side to not own the home original account. That's just just my perspective. So we prefer accounts rather than brands, but as Emmett said, some markets do share deals, some markets do asset deals, and I think everyone's accepting of that.
Fully on the same page here.
Yeah, I would like to add, especially for European sellers, when you're thinking about like, shall I rather do an asset purchase or a share purchase? Obviously, on a share purchase, the first thing that comes in mind is that tax-wise, it would benefit you more. Anyhow, I would advise really go through the numbers and make sure that the tax benefits that you would have are higher than the extra cost that you probably pay during the due diligence phase if you're opting for a share purchase, because it is true that asset purchase is easier and faster, so probably would require less costs, less lawyer costs, and less time of due diligence as well.
It's interesting. We've seen a number of particularly US aggregators bid for European sellers by offering APAs, asset purchase agreement deals, and they still get SBA type deals from other aggregators. So there's definitely, I guess, a frustration by some buyers that they can't just do APA deals because it's easier. You don't have the liabilities that come with owning a company. But it's a difficult one because for the entrepreneur selling, it can be more tax incentive. It can be more tax lucrative for them to go to sell the company. Brilliant. Hanna, Kenny, Olivia, thank you so much for your time today, for contributing in advance of the webinar to the content and live on the webinar. Really appreciate your time. For all those listeners that want to get in touch with Hanna, Kenny, or Olivia, please reach out to the Fortia Group and we will introduce you, or obviously go direct. Hope today's panel was useful and look forward to the next one. Have a great holidays in the interim. Take care.
Thank you.
Yes, it was a pleasure.